it's easy to go, hey, the markets are going to crash. Great. When are they going to crash? If you go to cash today and market doesn't crash for 3 years, you miss out on a lot of returns. But that's also one of the other sides of this going into next year. We've had 3 years now of near 20% returns. And when you have periods like this where you have very strong returns over a 3-year period, markets tend to revert to the mean in terms of returns. In other words, you get lower returns in the subsequent years, almost like clockwork. There's an old saying called reversion to the mean is the most powerful force in investing. And that's kind of where we are now. We have very elevated rates of return in the markets for the last 3 years in a row. So again, you should start expecting that you're going to get a reversion back towards the mean average return of markets over time, which is, that 8 to 10% everybody always talks about. You should start to kind of expecting a reversion of those returns. Again, that doesn't mean the markets are going to crash at all. It just suggests that maybe returns going forward could be very disappointing in terms of 8, 9, 10% returns on a year rather than 17, 18, 19, 20. And all of a sudden you're going, man, this market sucks. I'm not making any money. But you should kind of expect that.
Lance, I could also make the argument that the market falls 10, 15%, but there's 300 stocks that are up next year.
Yeah.
That the market rotates from the NVIDIAs, from the Magnificent Seven to those other stocks that have been lagging for such a long time. Just because the market's up or down doesn't always tell you what the market as a whole is doing, because the Magnificent 7 or 10 or whatever it is 40% of the S&P. That's a big deal. So you have all these other stocks that have almost zero contribution. Even in 2000, when a good number of stocks were down, small cap value did extremely well. Value did well. So there's usually a place you can rotate into. So again, whether the market's up or down next year, the goal is to manage that risk, but also to rotate into and out of the sectors, the factors, the type of stocks that are working or not working.
Looking at the break between value and growth has outperformed value by such a large stretch, particularly over the last couple of years, that you almost kind of expect at some point some type of reversion in that value growth trade. And if you start digging down into kind of the S&P, you start looking at staples and utilities and real estate, there's some really good value there with high dividends. I mean, you can buy some of these stocks and pick up, 3-4% dividend yields where you're waiting eventually for price performance to improve. There just seems to be a lot more opportunities starting to show up, to your point, in that kind of that more defensive risk off sector. So to your point, you could see a correction in the technology, healthcare, finance stocks and see a big rotation into the more value oriented stuff.
Catch me daily on The Real Investment Show. The link is in the description.